Hi, my name's Adam. Welcome to the channel. Thanks for joining us today. Today, we're going to be talking about dividend investing for retirement. So, how to create a dividend portfolio, what that looks like, and how it's beneficial for your retirement plans. So, as you know, we usually cover financial planning on this channel, retirement, estate, tax, financial plans. Today, we're talking about investing, and we're joined by Chris Richard, who's a portfolio manager at BCV Asset Management out of Winnipeg. So, this video is going to be a little bit different than what we usually do, but it's going to bring a ton of value around investing. As you know, your investments are such a huge part of your overall financial retirement estate plan. Okay. And usually that's all we focus on. Of course, we've launched this channel to show like there's a lot more to your financial retirement plan than just your investments. There's so many other pieces to it, but we do want to dive into the investment stuff. So I'm not a licensed investment person. I am a financial planner. So we really lean on investment professionals like Chris to help our clients out if they need help with their investments. So I'll quickly introduce Chris and then we'll jump into the video, and hopefully you find a ton of value out of this. And again, at the end of the video, if you enjoy these, hit the thumbs up. It really does help get these videos out to more people through the YouTube algorithm. And again, if you're not subscribed to the channel yet, please hit the subscribe button. It takes 1 second. It costs you nothing. So thanks for joining us. Let's jump into it. Chris Richard is a portfolio manager that works for BCV Asset Management, Inc., a registered portfolio manager, investment fund manager, and exempt market dealer that is independent from Parallel Wealth Financial Group, Inc., but works with referring advisors, much like myself, to provide discretionary portfolio management services to our mutual clients. So Chris, talking about dividend income strategy for retirement, just a few examples around, where you guys have invested, a couple companies that you see, and just how they work. Maybe jump into that.
Sure. So for us, we really find that in retirement, it really works well for clients who are looking for like an income replacement to, their day-to-day lives, where they have a retirement portfolio that not only pays them, a dividend or interest, whatever you're buying stocks or bonds, but also having a dividend and income stream that is growing in retirement tends to be like the best performance and usually happier clients when you kind of have that growth. Every day your expenses are going to be going up. Inflation is real, it's here, right? So you need a portfolio that's generating cash flow that is able to kind of keep up with those extra costs. So one that I usually like to walk through is you kind of look at an example of, say, a Scotiabank, right? We've invested in Scotiabank since BCB was founded in 2007, and we have this great slide where we kind of show if you have the ability to invest $20,000 in a Government of Canada 10-year bond at the time, and $20,000 in Scotiabank stock, right? And no dividend reinvestment. And we wanted just to show the power of how much cash flow an investor would have, by investing in the bank stock with a growing income stream versus, a fixed income product like the Government of Canada, where rates had been kind of climbing down, right? So if you kind of look since 1995 until the end of 2020, the cumulative dividends that you would have received by investing in Scotiabank would have been, roughly about $131,000. If you invested in a 10-year bond, resetting it, when it comes due, you would have only received $27,000, just north of 27.5.
Crazy. And that doesn't include the stock price going up, correct?
No, but that's the price, right? If you're going to
Yeah.
invest in something like a Scotiabank, you should be rewarded to have that volatility, right? But if you kind of focus on the future and you focus on long term, right? These are great businesses run by phenomenal people that are not just paying you more of a cash flow out of the same stream of or same pot of cash, right? You need that growing revenue, that growing cash flow to reward shareholders with that ever growing dividend. You have to look for companies that have specific characteristics, right? You have to have, great management teams, great, moats around your business. So you have that stability in order to kind of grow that cash flow and then reward shareholders over the long term with a growing dividend.
And then you mentioned another company too. We'll throw a screen up, a slide up there, but CN Rail as well. So just like yield on investment. So maybe talk a bit about that as well.
Yeah, so I mean, CN Rail has been in our portfolio for a really long time. It has been a phenomenal business, right? I kind of joke that I don't see a day when we don't have two railways here in Canada, because it'd be almost impossible to create a third. And when you have those types of moats around your business, you're able to again, have that same, cash flow stream that's growing. CNRL became public in 1995, and adjusted for splits, your adjusted cost base would be roughly, $2.25. Right now, say this recording, it's in the mid 130s, right? So on top of that growth, it's rewarded you with a growing dividend over that entire time period, to the point now where quarterly, 61 and a half cents is what an investor receives. So in essence, if you invested back in 1995, every year now you're getting your initial investment back just in dividend income.
Crazy.
Again, that comes with investing for the long term, right? Focusing in on businesses that have those characteristics that really make sense to be able to kind of have that runway or railway, I guess, in this example, of just really good performance. you know, does it come with bumps? For sure, right? I mean, if you're investing in equities, it's not going to be a phenomenal ride the entire time, but focusing in on the core strength of the business and the business that you're owning really does help kind of have that track record of growing those earning streams for the business.
For sure. And when you say 1995, it's not like it's that long ago. Like, yes, it's 25 years ago, but for many people that are watching this on YouTube, if 20, even if you're entering retirement, if you're 60, like 25 years, sure, you're 85, you might be getting near to death, but that still means you've now owned, CN or Scotia or whatever the company is for 25 years. Like, I think the fallacy is a lot of people entering retirement say, well, I need to draw out all my money right away. And the reality, even if you have a pretty aggressive drawdown on your RSP or your RIF, you end up holding companies for longer than you think you might anyway.
That's fair. I mean, I think my dad still has clothes from 1995, right? It's not that long ago. You
Yeah,
still have
exactly.
these phenomenal businesses that have they changed, a little bit, right? Because business changes, right? And as you have inflation, every day you go shopping, usually what you buy is more expensive this year than it was last year, right? And now as we're coming out of the pandemic, inflation is a hot button topic. So you need to have these revenues and cash flow streams supporting individuals in retirement. We're all living longer, right, for the most part, and we want to make sure that as we enter into retirement, we have an income stream that is able to sustain our retirement portfolio for as long as possible. I mean, if you're drawing out a significant amount of your RIF, it doesn't really matter what you're holding, right? However, your best shot is to have that good businesses, strong fundamentals, and have a growing cash flow stream to kind of support an investor in retirement for spending needs.
Yeah, no, exactly. And the last company I wanted to touch on was United Health Group. So this is something I think you guys own in your portfolio now. Maybe just talk a bit about that. And again, talking about stock price, quarterly dividend, and just around the dividend yield and how it can, benefit shareholders in retirement.
Sure. Yeah. So United Health is not a phenomenal yielder, I will say, right? It's not going to be like a Canadian bank that's going to give you, a very large quarterly dividend, but the growth is there, right? Over the last, 5 years, it's the growth in the cash flow per share and the dividend has been, mid-teens to high teens. But how do they do that? I mean, the focus in on for us is companies who can do it, who can grow their dividend because the cash flows are growing, right? Revenue is up, earnings per share are up, cash flow per share are up, and they reward shareholders with their growing dividend. What we see sometimes people say is, oh, I buy a dividend growth company, but they're paying a larger dividend from the same cash flow per share year over year over year. That's not healthy, right? You need to have a growing company with growing cash flows in order to reward shareholders with that growing revenue stream, because after a while, you're just going to be starving that company of cash flow, right? United Health is able to reward shareholders with the phenomenal growth in dividends because its business is growing, right?
Yeah.
It's been able to grow that top line, bottom line, and cash flow per share, and then reward shareholders with a really nice dividend growth. So you're not going to have that phenomenal 4 or 5% return or just on yield in United Health, but you are going to get a growing dividend, or you have received a growing dividend over the last 5 years. And based on fundamentals right now, we see that kind of trend continuing.
Yeah. No, that's a good point too, right? Like, where does dividend growth come from? Is it, like United Health, where it's actually a growing company and they're taking more of that profits, or are they just giving back more out of are they, you basically slicing the pie smaller on their profit side to give that bigger dividend. So it is important when you look at a dividend company, I guess, like where is that coming from? Where's that growth, dividend growth coming from?
We see like in Canada, like there seems to be more investors that like to have larger dividends, right? You need to have that growth though. Otherwise, you're just businesses need capital to grow, right? You can't just be stripping out every cash flow dollar to return to shareholders because then the company won't grow because you'll be taking too much the fuel that that company needs in order to transform itself to go into the next great thing, right? Every company needs to continue innovating, right? And if you have the cash flow growth to reward shareholders, that's the right way to do it, in our opinion, right? Is to make sure that the cash flow is growing, they reward shareholders with the growing dividend, just because everything else seems to be working.
Yeah, no, sounds good. Sounds like a great idea for kind of creating income stream in retirement. And that's, when we talk to clients, when we build out financial plans for clients, a big discussion is like, how do we generate consistent cash flow? Because, we'll run projections at say 5%. And I always tell clients like, hey, if you can buy a kind of, I call it a meat and potatoes dividend portfolio that's, clipping a yield of 3 to 4%. Well, you don't need to get much more to kind of meet our projections. So, when we put financial, fee for service financial plans together for clients, I always say, we're basing it on 5%, but you lose control of that. So that's why I like the dividend growth portfolio strategy. That's why I have my own money in it, even at my age, because it's just a great way to grow money. Again, it's kind of, again, performance can be really good, but I like the meat and potatoes part of it. It's a simple philosophy. We're not trying to hit home runs. It's just consistent growth.
I mean, I love home runs. I mean, don't get me
Yeah,
wrong.
fair
Home
enough.
runs are phenomenal, right? But usually, clients who are younger, they kind of say, "Oh, I need to take." Some people say, "I need to take this extra risk in order to kind of hit these, crazy returns month after month after month." And really, investing is not that, in our opinion, right? Majority of our clients that come to us, they've saved for a very long time, and this is their nest egg for retirement, or they've had an economic event where an inheritance, they've sold a business, and this is their forever money, right? This is what needs to sustain them in retirement or their lifestyle currently. And if you take those home run swings, sometimes you strike out.
Yeah.
And for us, we really want to focus in on the quality of the types of businesses we have. So I mean, you can't get away from the market, right? This past year kind of showed in 2020 at least that when kind of stuff went bad, nothing really performed well, right? Everything kind of was not didn't feel great to be an investor at a certain point. But what we told clients is, listen, the quality of the businesses that you hold are still there, right? I mean, it's just the market seems to be having a hard time right now. And we kind of had that conversation of saying, like, this is a time in order to hold quality businesses, right? If
Mhm.
any time there was a time to hold a quality business, it's now. And your portfolio always has to be ready for, I always kind of use like the next one of these, right? Something that you don't see coming down the road. You're always going to kind of stub your toe. There's always going to be a next issue to kind of have the market sell off. But when you focus in on quality businesses, you usually kind of can say, okay, well, at least I hold, really great businesses with great moats around them that are very profitable and have, check a lot of boxes on stability, but
Yeah.
also over time have shown to be great performers, right? So again, not every year is going to be a phenomenal year, but every year you're just going to be holding these great quality businesses.
Yeah, for sure. Perfect. Well, thanks, Chris. Thanks for going through this with us, and look forward to the next video.